Hey, it's Mike over at Cross Country Mortgage, and it's Monday morning. It's time for your Monday morning mortgage update for the week of September the 23rd. Really, the last week in September. Monday is the 30th. Hope you all had a great weekend. I had a great weekend. Spent time in Austin. Gail and I were there for an industry conference. Saw a lot of old friends, learned a lot of stuff, and really what the trends are in the market moving forward. Hope you had a good weekend. And so I always try to talk about things that are going to impact the market. So when you go out and have intelligent conversations with your buyers and sellers, you have some idea what you can talk about. Let's talk about what happened last week, and let's talk about what's going to happen this week. So last week, unless you were under a rock, the big news is the Fed cut rates. The Fed cut the prime Fed rate. It was the first time they've cut it in a few years. Everybody expected it. It wasn't if they were going to cut rates, it was by how much. So the expectation was a quarter, and they cut it by 0.5%. So my phone blew up. You probably got phone calls. People wanted to refinance. Should they buy right now? What are the rates? And nothing happened. The rates stayed flat. Let's look at the charts. I want you to see this. So if we look at this, this is a chart that shows the trading in mortgage-backed securities in the bond market. This is a 6-month average or a 6-month chart. On the right here is a live feed today. This is a live feed. And you can see if we go back just 5 days from where my cursor is, we saw no change. There's a little bit of movement here, but no change in the market. The rates ended Friday the same way they started. In between that, we saw some ups and downs. So why would rates not get better if the Fed cut rates? Because the Fed fund rate, when they cut that, it does not impact mortgage rates directly. It's a short-term index, and so it affects credit card rates, auto loan rates, for an example, home equity line rates. It affects the rate that businesses are charged by banks when they borrow money. So if a business was going to borrow money on Tuesday, when they borrowed money on Thursday, that rate actually got better. The money got cheaper, which is good. And so why is the Fed doing this? Because they saw signs that inflation is starting to get under control. Inflation is the death of mortgage rates. As inflation stays up, mortgage rates will stay up. And so as inflation starts to get under control and they see it starting to come down or flattening out, then mortgage rates are simply going to improve. It's that simple. So the Fed or all the lenders baked in this estimated rate cut. So the rates we were quoting on Monday of last week and the week before were already anticipating this Fed rate cut. We can go back 2 weeks here and see that there really hasn't been very much of a change in the last 2 weeks. It's been very flat. But that's not what the media said. Rates are cut, mortgage rates are dropping. It's all clickbait. It's all misinformation. They look at what the Fed did and they just assume these rates are going to come down. And you're probably getting tons of phone calls, or your clients are getting tons of phone calls about lower rates, refinancing. I got somebody that said they got a 4.99% 30-year fixed offer. When I looked at the numbers, massive points charged on it. So we just have to help our clients see the forest through the trees and realize that yes, rates are on their way down. Yes, it's a good time to buy. Take advantage of the market as it is, but don't think these rates are falling off a cliff. It took a long time for them to get up, and it's going to take a long time for them to come down. They're going to come down. It's just going to take some time. So give you some insight when you have those conversations with your buyers and sellers. So let's talk about what's going to impact the market this week. There's a few things, a lot of data coming out, not just a few, a ton of data coming out this week that's going to make the market very volatile. So inflation is the number one thing. Fed speakers, the consumer, what's happening on that end, and some other data. So let's talk about inflation. A big report coming out Friday, the PCE report. It's the number one report the Fed uses to determine their policy on cutting rates in the eyes of inflation. And it's expected to go up a little bit Friday. Right, it's expected to go up. Now everybody says, wow, inflation's getting under control. Yes, it is. It still costs a ton of money to buy groceries and to put gas in your car and buy tires or whatever else you're buying. We all know it's more expensive than it's ever been to go out to dinner. But it doesn't mean that inflation is not starting to wane. It's starting to flatten out. So the PCE, if it hits expectations, if the numbers hit what we expect, it's going to be good for rates. If it goes above that, if inflation rises higher than that, it's going to be bad for rates. So we'll be paying a lot of attention to Friday's report. It's always a big report. Fed speakers. So the Fed came out, ended the meeting on Wednesday. Jerome Powell came out with his press conference. And if you really look at what he said and read what he said, look, we aren't guaranteeing a rate cut in December. It's not what the media reported. They said, oh, yeah, we cut. They're going to cut again, and they're going to cut again. Yeah, we're going to start to see rates cut as long as the data supports it. The Fed's been very clear that they're only going to cut rates when the data supports it. So Jerome Powell said, look, there's no guarantee we're going to cut rates in December. It could be flat. So will the Fed speakers that are coming out this week giving their press conferences and paid speaking engagements, will they be saying the same thing? One of the main Fed speakers who's a voting member this morning, Kashkari, actually said he thinks inflation might be too low or coming down at a higher rate than expected, and that could be bad. So there's just so much different data out there. It's so hard to weed through it, but people are going to be paying attention to what these Fed members say throughout the week. And then the consumer, two key reports that are coming out on the consumer confidence. Does the consumer feel good about the economy? Remember, confidence in the economy, buying stuff, good retail sales numbers, all means a strengthening economy, and that's bad for mortgage rates. If we start to see weakness, lack of confidence, then that is bad, signs of a weakening economy, and that's good for mortgage rates. So we'll be paying a lot of attention to those two reports that are coming out this week. And then a lot of data, a lot of housing data. We get this every month. It's probably not going to move the market that much, but keep in mind that we've had 2 months of negative appreciation, negative housing data nationwide. So we'll be paying some attention to that. And then the Fed's selling a lot of debt. So if there's an appetite for that debt, that could be good for rates. So what are we looking at this week? Very volatile, ups and downs. If we start to see any movement to the negative, we'll lock in and really suggest a locking those interest rates. But we're floating today on Monday. I hope you have a fantastic, productive week. If you have any questions, let me know. If you know somebody who can benefit from this, please forward it to them. I appreciate it. Subscribe and have a great day. We'll talk to you soon. Bye-bye.